Hey everyone, this is Ben. I publish the All in the Reflexes Substack. You can find me on Substack. I also post on X throughout the week, a couple of charts here and there, and the videos that I record will for Substack will show up on YouTube as well. Um, the so I'm traveling right now, so I have limited access to some of my data and reporting, and it's been kind of a long week, so I'm a little tired. So apologize if it's low energy here, but I want to take a look at some of the timing signals and a couple of charts after seeing today's market volatility. And I guess as a reminder, the things that I go through here are not trading advice or intended to be tailored towards anybody's portfolio. I just like to share my progress in thinking in the market, and it gives me a good kind of basis for my own development. So I hope that it's helpful for others, and as you have questions, please share them. They're helpful for me, and I appreciate that. Um, so taking a look at the timing signals, the most favorable that they've looked in the last few months was at the very beginning of May when we only had one yellow signal. But today, even though we had a 3% drawdown in the S&P today, and that's pretty decent for a 1 day drop. The timing signals remain overwhelmingly bullish, and they're actually better than in better condition than what we saw in the middle of May. Of concern, I would call out that we've got the 5% drawdown alert showed up for the Nasdaq today. The S&P is 3% below its most recent all-time high, and we'll take a look at each of those. And then the total return concept from Martin Pring is where we take a look at the rate of change for the S&P plus the average dividend for the S&P, and when the combination of those falls below the rate of return or the yield for 3-month commercial paper, then we're in a bearish state. So right now it's above, so that's positive, but the total return formula produces a lower result in the early days of June relative to May, and it's falling below its moving average. So it's a warning, but it's not bearish yet. Last month I did a video with some of the timing signals, and I used the Foundation of the Study of Cycles app to take a look at the S&P, and it called for a turning point on June 5th, which is today. Now we had the high earlier in the week on Wednesday, but this analysis called for the turning point today, so I thought that was interesting. I don't know that we'll see this again. These don't imply a forecast for the magnitude of movement, so I wouldn't take this to mean that we're headed down to 47.50. This is just tells us that we should anticipate turning points based on past cyclic activity in this asset class. Coming up next on it would be the early part of July. Now, if you watched last month's video, you also recall that we had looked at the seasonality, annual seasonality by 4-year presidential cycle, and we're in year 2 of the presidential cycle. So June of year 2 is one of the worst years, or one of the worst months for seasonality throughout the 4-year cycle. And this is past history, so it's not a prediction for what happens in June. But in the past, we've had only 25% of instances of June in year 2 of the presidential cycle close higher than it opened, and the average return has been negative 2.2%. And so we're seeing that volatility in June, and we would not be surprised to see more of it. But again, this is a reflection of what has happened in the past and not a prediction for the future. Taking a look at the trends by asset class, we've got short-term, intermediate, long-term, and these are ordered in the sequence that we see funds flow from one asset class to another. So funds will typically flow from treasuries into equities, into commodities, and then the US dollar index. In between these, I've layered Bitcoin, which tends to see its speculative movement occur prior to equities, and gold is where central banks and various market participants will start to allocate funds as a hedge against future inflation. And then once that inflation shows up, we start to see gold liquidate. And that's some of what we've seen. We've had commodities, pop up and do well in recent months. But what's interesting here is we've got the greatest short-term, greatest near-term and intermediate strength in the U.S. 10-year and the U.S. dollar index. We've got weakness in the short term for gold, commodities, and equities, and we've got weakness in the intermediate term for gold and for Bitcoin. Bitcoin's in really tough shape. We've got a waterfall drawdown right now that's pulled it down to about like 60,000. So this is actually fairly bullish in the sense that a rising U.S. dollar index puts downward pressure on commodities, which puts downward pressure on inflation, and funds flowing into treasuries tends to precede a movement higher in equities. So it's not immediate, but this would suggest that funds are, that this could be a trend where downward pressure on commodities creates a favorable atmosphere for equities, and then funds would flow from treasuries into equities. But we'll need to see more evidence of that sequence playing out. It's not something that I care to front run. So the next series of things that we'll look at are in a chart format or in like a matrix format. And we'll start with trend. So we're looking at the constituents within the S&P, within the NASDAQ 100, and within the Russell 2000. And this is the percentage of those constituents that are above their 20-day moving average, the 50, the 100, and the 200. And so what's interesting is even though we saw the S&P take a 3% move down today, the most current period is on the left. The top chart is daily. The bottom chart is weekly. And so even though we saw this heavy move down in the S&P today, this is actually one of the more favorable looks that we've had in terms of the number of constituents in the S&P that are above their moving averages in the last 20 days. So it's pretty strong. The NASDAQ is among the worst that we've seen in the last 2 to 3 weeks, and on a weekly basis, the trend still remains strong. So there's nothing alarming to me here. Now these trends can worsen, but despite the downward movement today, we still have quite a few. The majority of companies in the S&P are above their major moving averages. The next is relative strength of sectors to the S&P, and what we've seen, the weekly chart reflects what we've been seeing for the last month, and that's that tech and semis have been in charge basically, and these are ordered in the sequence that we typically see funds flow from the start of a bull market to near its top, and it'll reset over and over. It doesn't mean that we're at the end of a bull run when materials peak and roll over. The last two, we've got semiconductors and communication sector. These can be strong throughout the cycle and at various points in the cycle, but during a business cycle or the economic cycle, you tend to see overarching basis the financials, tech, REITs, and discretionary start to pick up first, and staples, utilities, energy, materials pick up last. And so what's interesting to me is that despite the S&P drawing down today, we've got financials showed relative strength, REITs showed relative strength, as well as industrials and healthcare. And these are things that we would look to see do well in the early part of recoveries. Next, we've got a look at breadth, and we've got I look at a few different charts for breadth, but this is the raw breadth metrics. So you've got the number of advancing issues, the number of declining, advancing divided by declining, the trend arms index, which is advancing versus declining, but also advancing and declining volume, the percentage of NYSE stocks that are above the volume weighted average price, those making new highs, those making new lows, 1 month highs minus lows, 3 month highs minus lows, 6 month, and then 52-week highs, 52-week lows. So when we take a look at the raw metrics in these breadth comparisons, it's it's weakened, but and it's certainly worse than the prior day. I'm not thrilled to see such a large number of stocks, of New York Stock Exchange equities declining, but advancing actually picked up a little bit. So you had 38 were advancing the other day, and now you've got 39. So it's actually among the higher readings of those advancing on the day. The new lows, you don't have a tremendous number of stocks making new lows today either. And then when we look at 52-week highs and lows, this we've got a drawdown today, but we just don't have a tremendous number of stocks making an extreme in terms of breadth. So that's what I would take away from this. Now, again, this can worsen, right? You've got a few of these that are worse than they have been in prior days, but for the most part, it's it's not awful, right? And then you take a look at it on the weekly basis. It's not materially different than the week prior. So I'm not seeing anything in raw breadth metrics that would jump out at me and suggest that we're headed for much more trouble. And I would need to see like probably 1 or 2 more days of worsening conditions before I'd start to feel very concerned. So that's not to say that we're not going to see a chart on here that concerns me, but this one doesn't in particular. Now we'll take a look at these are the measures that represent the participants in the market risk appetite, and so these are a proxy for risk appetite. Now this is a pretty bearish look, right? So commodities versus treasuries, investment grade versus treasuries, high yield versus treasuries, silver versus gold, those types of things. So these would, we would expect to see these green and picking up if investors were had an increasing, rising risk appetite, and we see that risk appetite is waning. So that's bearish, and this tends to, sometimes you see the breadth movement first, and then risk appetite changes. It looks like the shift in risk appetite might be the early mover. On a weekly basis, again, not materially different, but we do have slightly worsening conditions among these on a weekly basis to close the week. This is the another look at ratios and different indexes that suggest whether equities are in an environment that would support optimism or would support degrade optimism, right? So I'd look for breadth to give us some, point us in a bullish or bearish direction. I'd look for risk appetite to point us in a bullish and bearish direction, and then do underlying conditions in the market related to liquidity and risk support those support that directional movement. And in this case, the headwinds are relatively bullish. You've got USDT I use as a proxy for sentiment and liquidity, and that's we've got dominance moving into the stable coins. You've got the US dollar index picking up, and that's fairly bearish, but you've got the overwhelming number of these measures are bullish and improving, and so that's favorable. On a weekly basis, we can say the same thing. So headwinds would support a rebound and not support additional bearish movement at this stage. Now we'll get into the timing indicators. This is the top and the bottom indicator are my custom version of or measurement of the put call equity, or the put call ratio, and it's volatility weighted. So I'm comparing put call ratio to combinations of VIX, of average true range, and Larry Williams VIX, and I'm looking for at all of those things as a measure of risk, and when they're out of balance with one another, that tells us that we're likely to see something corrective. And in this case, it hasn't budged at all, and it remains bullish. Now we do have the S&P falling below the fastest of these trend lines, and that's the follow line. That's normal throughout the time series, but it's obviously a warning if we're below it. But nothing on this chart right now would cause us to move from green to yellow. Now I will point out that we've talked about this on prior analysis, where we have the concept of strongest bar against and strongest bar for trend. And in this case, we've got a really strong bar against trend, and that's very bearish. We don't have to look back very far to see others. Like we were in the middle of a pretty lengthy uptrend coming into the fall in 2025. So early part of October, we would have called this out. We've got this large candle where it's a 2.7% drawdown, and when we have a strong candle against. To confirm that we're still in a bullish environment, I look for there to be an equal or larger bullish candle in favor of trend. And remember, we never got it. So you could still go on to make a new high, but it didn't last. Right, we had these weak and sloppy candles up near the high in the early part of November. Then we had a second large bearish candle against trend. We go on, we make a new high. But it's fairly choppy. Another strong one against. This one was fairly strong in favor, but not stronger than the earlier bearish ones, and we get this large drawdown. So past market history is full of these things where it's like, we've got these strong bearish candles against, and then once we get a really strong bullish candle in favor of trend, we can tell that we've got returning confidence. That happened all the way through this. March to April drawdown. We've got the strong candle against to continue our drawdown. We never really make like a new high with a continuing trend. We get it like in a very topping type of fashion. Then we make our drawdown. We've got the reversal, and we've got a strong bullish candle in favor of trend, and then we gap up, and we're doing pretty well. So what we'll want to see if we have a rebound and recovery, we want to see a large candle that's maybe a 2.5% to 3% move up, and with high volume to suggest that we're remaining in the uptrend. That would give us the most confidence. If we don't see it and we start to move higher, it's still a market that I would participate in, but I'm going to be very skeptical and cautious until we see that strong move in favor. Taking a look at the first of the breadth measures, again, this is like the second on my market timing charts, because we've got the long-term cumulative new highs minus new lows. It's kind of flattening out a little bit, but it's we continue to move higher, and it continues to remain above its 50-period moving average. The short-term rolling new highs minus new lows, this is on a rolling 10-day basis. It's above its moving average and slightly rising. So this still looks fairly bullish to me. The volume has kind of flattened out. I'd like to see, if we're in a bullish environment, I'd like to see the NYSE volume falling as these are improving. That usually suggests that you're in a gradual continuation. And right now it's like arched up a little bit. So we'll keep an eye on this, but I don't see anything here that alarms me right now. This chart looks at the selling climax. We have not exceeded a 4% bloodbath alert since the middle of May. And on the bottom, we've got our external risk factors. I keep talking about replacing this with another external risk factor measurement, but right now this chart remains in bullish territory as well. And we can see on the 30-minute chart, we haven't seen any violations of this 4% threshold in the last week. Last couple of weeks at least. And now at the bottom we've got the extreme vulnerability indicator, and this is nowhere near the 65-period threshold for us to be concerned. It is ticking higher without resetting. We haven't had a reset since the end of April. And the middle indicator is the advanced decline line divided by its 32-week moving average. It's not breaking below or above, but it's not breaking below its Bollinger Band, which suggests that the movement down in the advanced decline line is not aggressive. It is, it's a higher low right now, and it did not make a higher high, but it's not, it's moving down orderly and not in an aggressive and alarming fashion. So no concern for me right there. This chart looks at is the S&P above its 200-day moving average, and it is, and then how many of the S&P stocks are above their 200-day moving average versus below. So right now we've got about 58% of the S&P is above its 200-day moving average. The average true range divided by its 21 period moving average remains in bullish territory. It looks like it's curled up a little bit. The weekly never did move back below into that bullish threshold that we were looking for. So I might reconsider how we want to tag this one. But generally these are still sloped down, and I'm going to look for a little more deterioration on this chart before I would be alarmed here. This is the one that's probably going to be the most concern. I'm big fan of Andrew Thrasher's work, and he published that 5% canary paper that I've sworn by for risk on, risk off opportunities. And so the way that works is you've got a new all-time high or a new 52-week high in the index, and the time frame in which we see a 5% drawdown tells us how much risk we should expect. And so right now we're 3% below the all-time high, and this indicator turns yellow as a warning if we've gotten there before we're halfway through the 15-period monitoring session. And so that's happened. It can recover, but so generally, as long as we're above 72.30, we remain fairly bullish, and if we stay below that or above that by June 24th, then this is a buy the dip opportunity. Now, if it closes below there and remains below there beyond June 24th, it's not necessarily bearish. It just means we've got a signal or an alert, and then an alert becomes a signal if we have two consecutive closes below the 200-day moving average, and we have not had that in quite a while. Now, the Nasdaq was not part of Andrew Thrasher's study. I pay attention to it because it's an index that I trade, and I trade a lot of stocks that are in it. But I did not give a signal on this index as much weight because it was not part of his back test or intended to be used with the index. We did fall more than 5% below the 52-week high, and that should have signaled something above on this chart. So I needed to take a look at why our grid on the upper half did not color code that. But so right now we're below it, and we want to see the Nasdaq get back above 29,130. And then last but not least, you've got the Dow, and which is pretty common with the Dow. It made its high after the S&P and the Nasdaq, and we're only about 1% below, 1.5% below the all-time high that it made on the 4th. So we'll want to see the Dow stay above 49,000, and we'll want to see it close above 49,000 by June 26th. The multi-time frame momentum model for the S&P. So we've got a strong bullish trend on the monthly. This is where the long-term trend exists, is on high time frames. In the intermediate time frame, on the weekly basis, we're confirming that trend that we see on the high time frame. We remain above rising moving averages. We've got rising average directional index with the positive directional index above the negative directional index, and our momentum indicator, the RSI, remains in bullish territory. So that's very good. On the daily, we remain bullish. We've got bullish RSI. It would have to fall below. We would have to fall below 7,280 for the RSI to turn bearish, and that kind of coincides with the 0.382 for Fibonacci retrace that we draw from the momentum crossover to the high. And so this is an area of value to add on a retest. If we were to see the S&P close below it for 3 sessions in a row, and the RSI move into bearish territory, that would be the risk-off signal using this particular system. So right now, still bullish. One thing I want to keep an eye on is we've got this gap that is between between May 5th and May 6th, and that's coinciding with the moving average and with the 382. And not all gaps fill. Gaps get a lot of attention, but they don't always fill. This is a breakaway gap. Breakaway gaps occur at the beginning of trends. And then you get running gaps, and you've got a couple of those here. This would be I would consider this to be a runaway gap, and then if you were to see like a very large one late in a trend, that's considered an exhaustion gap. This does not look like an exhaustion gap to me. You break above it, you come back down with a little retest, and you come back up. So this looks like the normal type of gap that you see in an uptrend. And if we were to test it, even a fill or to maybe to the top of these wicks, just a little bit below that 382, I would take that to be very bullish personally. So we'll keep an eye on that gap. And I think I've got another chart where we'll see something else interesting pointing to it. This is the one of Martin Pring's charts that looks at commodities and like a commodity momentum model and the S&P that is adjusted by inflation. So the short version of the story is this remains bullish. You've got commodities in a rising momentum environment. The rate of change for commodities and equities is stable and in a bullish proportion to one another. And we have not had an alert on this since March. And this is a monthly chart, so you don't get very many alerts on it. A model that I started testing and developing in the early part of this year looks at the VIX relative to the skew index. And the skew index is was more important years ago, but it's still a relatively valid signal. It's indication of how much risk the market is preparing itself for, and the VIX is how much volatility is occurring. And we've got to use some fancy math to be able to compare them on the same grid. But the short version of this story is that it's continuing to rise and has not rolled over. So this is fairly bullish. Once these roll over, we'll start to see like a lengthy divergence with the market, and that should be our risk signal. And sometimes it takes 2 attempts to break through that. This is fairly experimental still, but the relationship between these 2 indexes has been studied by a number of people, and so it's still in fairly bullish territory, and we would need to see a little bit more signal degradation before we would take this to be bearish evidence. This one's very busy, but I've got 3 composite models for breadth, risk appetite, and the equity headwinds. And this is really, really similar to those charts that we looked at the very beginning. So, we said that typically breadth will give us our earliest signal. That will be confirmed by a change in the risk appetite of market participants. And then lastly, we could see a breakdown in equity headwinds or a bullish movement in equity headwinds. And those things would kind of move in sequence with one another. Right now, they're still technically bullish. We've got, one red candle movement below the 0 line on breadth on a daily basis. On the weekly, they're all moving up still. But what I do want to point out is that these are diverging. So you're putting in a lower high. When you come out of downturns, you get really big. They call it a breadth thrust. So you get a really large movement in breadth upwards, and then that's going to be confirmed by risk appetite having a surging recovery and equity headwinds supporting that upward movement. Becoming a tailwind essentially. So it looks favorable, right? Except you've got this divergence, and divergence is they can resolve themselves. They're a condition that is a warning, but they're not a signal to act. But in this case, we've got a lower high in the trend line for each of these, and that is a warning right now. So even though these are bullish, we want to see at least one of them come up and test the upper boundary of this measure. This one is not. I don't think I've included this one in a recording before or in an analysis, but this is the put call equity ratio in black, and I've got a 10 period moving average in Bollinger Band around it. Now you can see this is a really, and I'm not including it, I think it's probably because it's so noisy, right? But it's constantly bouncing up and down between the number of puts and calls that are that the market's using, and so by itself it's kind of tough to interpret because of that noise. I've tried a couple of iterations of the super smoother. It's still, I don't think it's very helpful for me yet, but what I'm looking at is the distance that the put call equity ratio has moved from its moving average. And so you can see we it'll get these Bollinger Band breakouts and breakdowns all the time. But the number of times that it makes a measure, this extreme of a distance from its moving average are fairly seldom. You get like a couple a year. So taking a look back in time, the number of times that the put call equity ratio breaks above its Bollinger Band and makes a movement this far away from its moving average, it's kind of a mean reverting event, right? You tend to not be terribly skewed in one direction for puts and calls at the same time. So it's kind of a mean reverting measure. So these tended to occur near local lows in the market. We have to go back to 2023 to see a couple of them occurring at a high, and that's when they occurred in a sequence fairly tight together. This one that we got in February was it was a local low that resolved higher over the next few the next 10 trading sessions, but then we ultimately had to move lower. So in general, the market hedging itself with a lot of puts represents fear, and the market's not always going to be wrong when it makes that decision. But when it moves this far away from its moving average, it would be reasonable for us to see a bounce back as early as Monday, maybe even over the next couple of days. So keep that in mind. It might not mark the low of a move, but we might see a mean reverting rally in stocks after seeing the put call equity ratio move this high this quickly. We looked at this on one of the last couple of videos, but this is the 18-month, 12-month rate of change for CPI, and then on the bottom we've got commodities divided by the CPI, and it's the KST for that value. So this is Martin Pring's long-term KST, and what we said is the KST is, so this is your momentum indicator. It's pulling away from its moving average, and it's rising steeply, and we've not seen it move up that steeply above the zero line since 2021. And when we saw that happen, inflation was rising pretty steeply, and this 18-month rate of change might look more gradual. If we look at it directly, this is the highest that it's been since 2024 on the 18-month rate of change. It's taken out the prior high from 2025, and when we get above 5% rate of change on an 18-month basis for CPI, we tend to see some downward pressure on equities, is what we said we would expect, and that's what's starting to happen. So in these cases, we're in 2022, this is where the Fed is stepping in and trying to put downward pressure on inflation, and that puts some downward pressure on equities for a while. Again, back here in 2008. So it's and I'm not going to be on here predicting that we're about to see a 2008 episode or a 2022 prolonged bear market. What we're saying is that this represents a condition that puts downward pressure on equities, and we'll want to see it resolve or adjust the way that we participate. But it's not to say that the end of a bull run is coming. But this is fairly bearish. Now we get into this is from time trades, and you can find these indicators through Blair's site at time-trades.com. I anchor, so this is esoteric, right? But I've had a good deal of success using these tools to find support and resistance, turning points, dates of interest, and to get a better perspective on the movement of trend. But they take some getting used to. But these are fantastic tools to work with. So I prefer to anchor when it comes to the S&P. I prefer to anchor to eclipses, as those represent like volatility and turning points in the market and tell us when the market's kind of moved away from the influence of those volatile periods. And the trend, you've got some immediate impact after an eclipse, but you've got some like an anchor point or point of interest that it can revisit over time. So this is from the 2025 eclipse season, and this was at the beginning of it. And then we've got these others that are anchored to the eclipse periods at the beginning of this year. And so we saw, initially we traversed the trend lines downward, and you're finding support at the trend lines, and then as it recovered, we're finding support and resistance at the horizontal lines that are in the Gann square of 9. And so that told us that we're, even though we've got this big gap up, right, we're having an orderly recovery, and then we begin to navigate the ascending trend lines anchored to the second eclipse. So that was all looking fairly favorable, and then intersections of the diagonal lines in the Gann fan and the vertical lines in the square of 9 tend to be of the most interest to me, and where we tend to see, like pivot points and things. So we're approaching this intersection of the Gann fan from the 2025 eclipse period and the one from the 2026 eclipse period. And so as we're getting into that intersection of them, you can see price tightens right up and reverses right into the, this next vertical date of interest is June 8th. So, you've got this reversal, this strong candle against, it finds support right at the, 7,300 level in the square of 9. And remember, on the prior RSI momentum chart, we said, as long as we're above like 70, I think it's like 72.80 or so, we should remain bullish. Well, look at this. We come down and we've got an intersection of the angle from the most recent eclipse period and this vertical line on 6.8. And so you've got this kind of intersecting period right here that is between 72, 75 and like 72.90, 7,300. So I'm thinking if we do see some continuation lower on Monday, maybe it rebounds at this level and starts to move back upward. I think this direct intersection between the Gann fan from the prior eclipse period and the one from the most recent eclipse of 2026 on June 12th, I think that's probably going to be the date of the most interest to me. What we see happen there might be worth keeping track of. And again, we come down to, let's say we do come down to this intersecting period. What does that line up with? The gap from May 5th to May 6th. And actually the square of 9 from the first eclipse in 2025 aligns right to the middle of that gap. Middles of gaps are interesting. If we find support at the middle of the gap, that tends to be very bullish. Tells us that people that participants that were paying attention to that gap stepped in before letting it close. So we'll see what happens. But it's not a prediction, but a scenario that I can anticipate if price moves down lower. I'm anticipating that it would find support here and move upward. I would take that to be a bullish signal. See if there's anything else I want to look at on this one. Maybe thinking of the next one. Yeah, I think that's it for this one. And let's take a look at a similar chart for gold. This is a very bearish look for gold. So again, we're anchored to the eclipses. It's nice to see, something navigate the ascending angles, but it quickly falls out of the ascending angles and then starts finding support and resistance within the descending. Would break above, but now it's got this like orderly stair step down. This is very bearish, and so we've got this date of interest coming up on the 8th, and if it finds support here, I'm not going to take that to be bullish. I'm going to want to see this thing start to take some orderly steps upward. This feels like we're probably going to be moving downward for a little while until we have a catalyst that moves it back up. My long-term perspective on gold is that we'll probably see it move higher into the tail part of 2027, but I'm going to need to see some additional evidence to support that that bias. And I think was this the one that I had? Yeah, I've got some AVWAPs that I anchored. So let's take a look at those. And so this is about as bearish as it gets for me. I've got anchored VWAPs to prior highs and failures into those AVWAPs. I'm anchoring new ones. And we're just, a cascading series of lower highs failing into these anchored VWAPs. It's fairly bearish. And the one that I would look at, what's interesting to me here is we've got an anchored VWAP from the from this corrective movement that we had in April of 2027 is starting to trend towards this descending angle near the 4100 mark, 4050. So that's not a prediction that we're going to land on it, but you can see that it wicked down and tried back here in March, and so it's possible that we're going to see gold continue to move downward and come into alignment where this anchored VWAP from that correction that we saw about a year ago lines up with this descending angle. So we'll see. That's again, not a prediction, but a scenario that that I'm paying attention to. If it does do that, I'd probably step in there and add a little bit to our position. Now, last one of these that we'll look at with the astrological charts is the VIX. In terms of time, this did not help us with timing on the VIX. So we've got, we had this consolidating, tightening movement in the VIX, and I was thinking, we'll probably come down. Could see it continue to come down into July, into this intersection, and we've had some serious turning points at these verticals in the square of 9, and that's told us, helped us to anticipate large spikes and reversals throughout the time series. So we're seeing this spike outside of those verticals is interesting, and away from the the intersections is interesting to me. But it did find resistance right at the ascending line. So I take this to be, suggest to us that we probably will not see the VIX move above 22. If we do, we could be looking at a scenario where we've got high volatility for an extended period and possibly even into and throughout the summer. So we will see. But interesting to me that VIX came up and met resistance today right into that ascending angle. Now, last chart that we'll look at, how will we know that we have seen the bottom in the S&P and in the end of, that we've seen the local low in the S&P? Same way that we always have, we've got the Keltner channel, and this is default settings in the Keltner channel. So 20 period using a 2x multiplier. The bands are using average to range. And so what we've got is the 100% of the time since I've been doing this, when the upper band of the Keltner channel makes a high and rolls over, we have always seen the low in the S&P, the local low at least. And they're offset because the timing of the VIX is a little bit different. But, so it's not the perfect bottom, right? Like take a look at March of 2026, earlier this year. We've got a confirmed high in the upper band of the Keltner channel. It starts to roll over. Now you can't act on this like immediately because you need a couple of days of evidence that it's actually moving down. But once it rolls over like that, we've confirmed that the 30th was the low, and we proceed to go on a nice uptrend. Now remember we pointed out these red tags. These are these come from Andrew Thrasher's study on compressed volatility, and we have the VIX and the VVIX, which is the volatility of the VIX. We're in a compressed state where they're both below a very low standard deviation for an extended period. And when that happens, you tend to get like an explosive movement in the VIX, and you'll see it like within the average is within like 15 sessions. We got 19 sessions in, and we saw a 40% spike in the VIX today. Unfortunately, not enough to put my volatility ETF position into profit, but that's how that goes. It's not advisable to trade go long volatility on this signal, but it is advisable to close your volatility shorts and to be aware of potential positioning for a volatility spike. Now, what's interesting is we got this compressed volatility at a low right on a cycle reset, and now it's possible that this is going to be a left translation into this cycle, which would then go on to compress volatility into July to early August. So we'll see how that plays out. Last thing I'll note on this chart is that volatility moved. What does this measure down here? We've got volatility moved almost 5 points above its 10-period moving average. 5 points above or more above the 10-period moving average tends to be an exhaustive movement in volatility, not always the high, but usually in proximity to the high. So that is a pretty steep movement. We might see more than one of them after this volatility spike, but let's keep an eye on that as well. So again, we're going to want to see this upper band of the Keltner channel make its high and roll over, and that will tell us when we've seen the local low in the S&P. So that's it for tonight, and I hope this is helpful. If anybody has questions, anything else that you'd like me to take a look at, or something that you've seen that I could share, please feel free to let me know. Thanks.